Hi, my name is Claudia Zeisberger, a professor of entrepreneurship at INSEAD, where I focus on private equity and venture capital. In this part 3 of my introduction to PE and VC, I will take a closer look at the fee structure in private equity, and you will hear more about carried interest. For the purpose of the lecture, we will take a look at private equity from an institutional investor's point of view, meaning from an LP's point of view. You will remember from our last lecture when we looked at the generic private equity and venture capital fund structure, we spoke about LPs and GPs, and we spoke about the fund being usually structured as a closed-end limited partnership, meaning those private equity funds have a finite life, usually between 10 and 12 years, are highly illiquid. So the LPs, the investors, commit to the fund for a solid 10 years and are at the start blind pools of capital, meaning the individual portfolio companies are not known to the investors. Mainly a broad mandate of the fund obviously is being discussed prior or during fundraising. So how do LPs invest in private equity funds? Imagine you are the CIO, the Chief Investment Officer of a large pension plan, and you have allocated a total of, let's call it 10% to be invested out of your total AUM into private equity. The rest will go into other asset classes, public equity, fixed income, and so on. You will then basically go out with your team and find suitable private equity and venture capital funds that fit your risk appetite and fit your mandate. At that point, you will be committing capital to those GPs. No funding, no dollars change hands at this point. Nevertheless, you are signing a legally binding commitment to invest in this respective fund. If and when the GP then finds suitable portfolio company, they will issue a drawdown or a capital call to all their LPs and draw down funding pro rata to the total capital committed by the LP to that respective private equity fund. Usually capital calls are being issued and money will need to be sent by the LP to the GPs within 15 to 25 days. Once capital has been received, due diligence on the potential portfolio company has been done and satisfactory, then the actual investment is being executed and both the GP and the LP have started to build a private equity portfolio for this respective fund. Now, how does a typical cash flow look like for an LP in a private equity and venture capital fund? So let's assume this is a 10-year fund, year 1, year 10. We just had our first closing here. That means we've started to invest in the respective private equity portfolio companies. So usually the first 5 years in a private equity fund are called the investment period. And as you can see here, you will see mainly negative cash flows, meaning the GP will call capital from the LPs to invest in potential portfolio companies. Usually between 2 and 5 investments per year are being done. And you can expect that we will have a total of 10 to 15 portfolio companies per fund. We call this the J-curve, meaning a picture of the cumulative net cash flow from the LPs to the GPs and back again. So again, the first 5 years are the investment period. Obviously, in the coming 5 years, we will see mainly cash flows from exits, meaning if and when portfolio companies are being sold, capital is not being reinvested, it is being returned to the LPs. So let's have a look at the fee structure in private equity. So usually we have in private equity a management fee that is being paid, called 2% per annum on committed capital that's being paid by the LPs to the GP. We then have a rule that out of all the net profits achieved by the fund, 20% are being paid to the GP. It is called carried interest or carry, and is the main incentive for the GP to build and manage a successful portfolio. This fee structure is usually casually in the industry referred to as 2 plus 20. 2% management fee plus 20% carry. In the LBO space, in the leveraged buyout space, we have additional fees that are occasionally being referred to, and I will come to that in a second. The private equity fee structure is considered in general as opaque. I would argue that in the last 10 years, the GPs have developed reporting structures to the LPs that it is kind of hard to argue that it is still opaque nowadays. So let's go into greater detail. Fee structure in private equity. So the management fee, whilst we have heard it's called the 2 and 20 fee structure, the reality post-global financial crisis after 2010, 2011 is much more, is a much lower one. So for funds above $1 billion in terms of assets under management, the reality on in management fees in terms is really more around 1.5 to 1.8% on capital committed. Once capital has been invested, management fee usually drops down to 1.2% per annum. As soon as an asset is exited, no more management is payable. As I mentioned, upon exit, capital as well as profits are being returned to the LPs, and profits are being shared with the GP. Carry or profit share is 20% of realized net profits in a fund are being paid to the GP as incentive and obviously to align interest with their LPs. This share of net profits is paid to the GP after the LPs have first received their invested capital back, and secondly, have received a preferred return, also referred to as the hurdle rate, usually between 6 and 8%. I had mentioned hidden fees in leveraged buyouts. Those are usually fees that are being charged to the fund, like directors' fees, advisory fee, monitoring fees. They also in the last decade have become pretty much under fire. And I would say we have clearly seen a reduction in those fees to be charged to the funds. Nevertheless, fees in private equity matter and have a substantial impact on LPs, so on the LP returns. So LPs are strongly advised to be quite careful about their LPA, the limited partner agreement, before signing. Now, let's take a closer look what actually happens in terms of cash flows if and when a portfolio company is sold. We call this the distribution waterfall or the exit waterfall after the sale of the equity stake in a portfolio company. Let's have a closer look at the various steps. Step 1, the LPs receive all their capital back that they invested in that respective deal. Step 2, the LPs receive their hurdle rate between 6 and 10%. Only after those payments have been made to the LPs, the GPs will, as we call it, play catch up, meaning the GPs will receive 20% on all the funds that have so far been distributed. Assuming there is still capital available from the exit that has been received, the remaining funds will be split 80-20. 80% to the LPs, distributed pro rata, 20% of those net profits to the GP. So imagine we have an exit. We had a sale of one of our portfolio companies to, let's say, a strategic acquirer. We received cash. Step one, summarizing it up. Step one, we return capital to the LPs. We still have funds left. So here's basically total cash returned from our exit, still capital available. The LPs now receive their preferred return, the 8% hurdle rate. Step three now, the GPs play catch up, meaning we pay the GPs until they have received 20% of those dollars distributed to the LPs. And then basically in step four, any remaining capital is being split 80-20. Now, this is easiest to be understood in an example, but let me add one more detail to it. There's always more in private equity. Yes, I know that. So the distribution of carry can happen in two very distinct models, a European style model or an American style model. That model is defined in the LPA on fundraising. So the LPs are very clear which model is being used to distribute carry. Now, the European style, under this approach, carried interest will only flow to the GP if and when all of the contributed capital has been returned to the LPs, not just the contributed capital for this specific deal. Under the American style approach, the GPs receive money a little bit earlier because literally under the American style approach, all we do, we distribute carry based on a deal by deal view of the private equity exit. So as soon as an exit happens, the GPs receive carry for the net profit in that respective exit. Now, let's have a quick look at a European style carry worked example. It's a very simplified example. We had our LPs invest $100 million in the fund. The fund then makes two investments only. Portfolio company one, portfolio company two, $50 each. Portfolio company one has a fantastic exit. We sell the stake in the portfolio company at $90, meaning we have a $40 gain. Since it's a European style carry, step one means we return money to the LPs. So all capital received out of that exit goes to the LPs. Remember, our LPs invested $100, so we still have $10 outstanding to pay to the LPs. So out of the first exit, the GP receives no carry. Portfolio company two, the GP was not that lucky. We have to sell the company at a loss, but still we're receiving $30 million back. First, $10 go to the LP to satisfy the rule that we have to return all money first to the LPs. Then the remaining $20 are being shared. $16 out of that go to the LP, $4 go to the GP. So the GP does receive carry, but only once all the funds have been returned to the LPs. So in this lecture, we had a closer look at the fee structure and funds. We learned about the 2 and 20 management fee plus carry fee structure. We also basically revisited the J-curve, and we have looked at a worked example out on the carry waterfall. If you enjoyed this lecture, please give it a like below. And if you would like to learn more, follow me on the channel. But also, if you're interested in going further into the structure of private equity and venture capital funds, please look out for part 1 and part 2 of this specific lecture series. Thank you very much.